The hidden price action trick pros use daily. There is a moment just before a stock moves when the tape tells you everything you need to know. Most men never learn to read it. They are too busy listening to tips, reading newspapers, chasing opinions from men who have never risked a dollar on their conviction. I have spent a lifetime watching the market, and I will tell you this plainly. The edge that separates the professional from the amateur is not intelligence. It is observation, patience, and an understanding of what price itself is trying to say before the crowd catches on. Let me tell you about price action. Not the textbook definition, not the chart pattern names that brokers sell to beginners. I mean the living, breathing behavior of a stock as it moves through time. Every tick on that tape is a vote. Buyers and sellers casting their ballots in real time, and if you watch long enough, you begin to see the pattern beneath the noise. That pattern is what I want to talk to you about today. The professionals and I use that word deliberately because there are very few of them. They do not wait for news. They do not wait for earnings reports or analyst upgrades or the opinion of some man in a fine suit on a television screen. They watch price. They watch how a stock behaves at certain levels. They watch what it does when it is supposed to break down and does not. They watch what it does when it is supposed to rally and stalls. These moments of divergence between what should happen and what does happen, these are the signals that matter. Let me give you the core of it. When a stock has been declining and it reaches a level where, by all appearances, it should continue, lower sellers are pressing, sentiment is poor, the news is bad, and yet the stock refuses to fall further. Something significant is happening. The professionals call this absorption. I called it the market telling the truth. Underneath the selling, there is a buyer, a large, patient, deliberate buyer who is accumulating shares without revealing himself. He does not announce his intentions. He simply shows up quietly on the tape and absorbs every share that the frightened sellers throw at him. This is the first trick, and it is the most important one. Learning to identify absorption in real time, you will see it in the price itself. Volume will come in heavy on a down move, yet the price will barely budge. The stock might trade 100,000 shares in a single hour and close almost exactly where it opened. To the untrained eye, this looks like nothing, like confusion, like a choppy market. To the professional, it is a flashing signal. Someone is on the other side of that selling, and they are doing it deliberately, and they know something the sellers do not. I made a great deal of money in my career by doing one thing that most men refuse to do. I waited. I watched a stock for weeks, sometimes months, before I ever put my first dollar into it. I observed its behavior at key levels. I noted how it reacted to news. I noted how it moved on quiet days when there was no particular reason for it to do anything. Because a stock that drifts higher on light volume with no news is a stock that wants to go higher. The path of least resistance is already upward. Someone has been doing the heavy lifting behind the scenes, and now the stock is ready to move. The second element of what the professionals do daily is understanding the concept of what I called the line of least resistance. This is not a complicated idea, but it requires discipline to apply. A stock that is consolidating, moving sideways within a defined range, is not a stock that is doing nothing. It is a stock that is deciding. It is coiling. The energy of that sideways movement is building toward resolution, and your job as a trader is not to guess which direction it will break, but to wait until the break is confirmed and then act decisively. Most men lose money in trading because they are premature. They see a stock near a resistance level and they buy, anticipating a breakout. Then the stock reverses and they take a loss. Then it tries again, and they buy again, and it reverses again, and they take another loss. By the time the stock actually breaks out for real, they have been stopped out twice and have no conviction left to hold the position. I have seen this happen more times than I can count, and I have done it myself in my younger years, and it cost me dearly. The professional does not buy the anticipation. He buys the confirmation. He waits for the stock to actually move through the key level with authority, with volume, with conviction, with the kind of price action that says this is real, this is not a false break, This is the genuine article. And then, and only then, does he commit his capital. He does not worry about buying at the exact low. He does not mourn the points he missed before the confirmation. He takes the clean, confirmed trade, and he takes it with size, because he has been waiting and he is certain. Now here is where most traders fail, even when they understand the theory. They lack the patience to wait, and when they do wait, they lack the courage to act. I want to address both of these problems directly, because they are the twin killers of trading accounts everywhere. Patience is built through watching. You must develop the habit of observing markets without the pressure of having a position. When you are flat, when you have no money at risk, you can see clearly. You can watch the tape without the emotional distortion that comes from having a stake in the outcome. Use those flat periods to practice. Watch how stocks absorb selling. Watch how they behave at key levels. Watch the relationship between price and volume. Build your library of observations. Because the day will come when you see the exact setup you have been studying, and you will recognize it like an old friend, and you will act without hesitation. Courage is harder to teach. I can tell you what I know about it, which is this: courage in trading is not the absence of fear. It is acting in the presence of fear, because your analysis is sound and your discipline is intact. The moments when a trade feels most uncomfortable, when every headline is screaming disaster and every amateur is running for the exits, those are often the moments when the professionals are loading up on the other side. Not because they are reckless, but because they have done the analysis, they have read the tape, they have seen the absorption, they have watched the price hold where it should have broken, and they know what the market is telling them. Let me speak for a moment about the specific way a professional reads intraday price action, because this is where the daily edge lives. Every morning, when a stock opens, watch the first 30 minutes carefully, not to trade, to observe. How does the stock open relative to the prior day's close? Does it gap up and immediately start to sell off? Does it gap down and immediately start to find buyers? These opening behaviors are diagnostic. A stock that gaps down and finds immediate buying interest is showing you relative strength. The sellers pressed it lower at the open. The bears had their chance to drive it down, and instead buyers stepped in. That is meaningful information. Conversely, a stock that gaps up and immediately starts to distribute, where sellers are hitting every bid, where the early buyers are getting out, where the volume is heavy but the price is barely holding, that is a stock in trouble. The professionals are selling into the excitement of the gap. They are using the enthusiasm of the amateurs to exit their positions at favorable prices. This is not speculation. This is the tape telling you exactly what is happening if you choose to read it. The third element, and perhaps the most subtle, is understanding the concept of pivot points in price. Not the mathematical formula kind that trading software generates automatically. I mean the natural, organic pivots that form when a stock has made a significant move, paused, and then resumed. These prior pivot highs and lows are the levels that the market remembers. When a stock returns to these levels, it is coming back to a scene of prior activity. Prior buyers and sellers are now confronted with the same decision they faced before, and how the stock behaves at these levels, whether it stalls, whether it blasts through, whether it reverses with force, tells you the balance of power in the market at that moment. A stock that returns to a prior high and pauses, then pushes through that level on expanding volume, is showing you a market with genuine demand. The buyers are not hesitating at a level where sellers previously took control. They are walking right through it. That is a sign of underlying strength that the casual observer will miss entirely, because they are reading the news, not the tape. I made my fortune and I lost my fortune and I made it again. And through all of it, the one constant was the tape. The numbers never lie. People lie. News lies. Tips and rumors and the cheerful enthusiasm of a bull market lie. But price, over time, reflects reality. And the accumulation of price behavior, the patterns of how a stock has acted across days and weeks and months, this is the most honest record in existence of what the real buyers and sellers actually believe about value. There is one more thing I want you to carry with you, and it is perhaps the most important lesson of all. Every day the market opens is an opportunity, but not every day requires you to act. The professional trader understands that sitting on his hands, waiting for the right configuration, is itself a position. It is the position of capital preservation. It is the position of readiness. The amateur believes that if he is not trading, he is not working. The professional knows that the discipline to wait for the ideal setup is the very foundation of his edge. When the setup is clear, when the absorption is visible, when the breakout is confirmed, when the price action is speaking plainly, then you act. You act without hesitation, with appropriate size, and with a clear understanding of where you are wrong. Because knowing where you are wrong is as important as knowing where you are right. If a stock breaks out and then immediately reverses back below the breakout level, the market is telling you that your read was incorrect. A professional accepts this information gracefully and exits without drama. He does not argue with the tape. He does not hold a losing position, hoping for vindication. He takes his loss, small and clean, and he returns to observation mode, watching for the next setup. This is the daily practice of the professional. Observe, wait, identify the absorption, confirm the breakout, enter with conviction, define the exit. Manage the trade with discipline. It sounds simple, and it is simple, but simple is not easy. The difficulty is not in understanding the concepts. The difficulty is in controlling yourself, your impatience, your fear, your greed, your need for the excitement of being in a trade. The market will test your discipline every single day. The professionals who survive and prosper are not those who are the cleverest. They are those who have mastered themselves. Everything else is secondary. Watch the tape, read the price, and never argue with what the market is telling you.